Hey guys, this is Adriana, and in today's video I will be analyzing 5 stocks I'm buying in May, which I think that they have the potential to outperform the market. First stock in this list is MasterCard, ticker symbol MA. It is a well-known payment technology company. I do have to say that I own both MasterCard and Visa stock, but I'm going to explain why I'm preferring MasterCard right now instead of continue increasing my position on Visa. Let's get to their valuation. MasterCard is a company that has a market cap of around $273 billion and a PE of 35.04. which yes, is a little higher than the industry average, but their EPS growth is way higher as well. Even though I might be paying a premium on this stock, I do believe that this company is well positioned to recover faster from the pandemic due to their competitive advantage. MasterCard has been having an exponential growth over years. Still, they had a slight increase of 3% in their revenue and a decrease of 9% on their net income. Obviously, because of COVID-19 spread, there has been a reduction of business activities impacting MasterCard's consumers and suppliers. And yes, people are still buying things online during this pandemic, but there has been a significant decrease on consumer spending. MasterCard is a company that, in my opinion, has a very good balance sheet. If we divide the total current assets of $18.12 billion by their total current liabilities of $9.7 billion, we get a current ratio of 1.86, which means that the company has more than enough cash to pay their current liabilities. Now, for their total debt to asset ratio, we get a total of 0.82, which obviously is not the best one since it means that they have more than 80% of their assets financed with debt. Normally, I like to see this number around 50%, but when we are talking about a company with an exponential growth like this one, it's fine to see a higher ratio. Now, as you can see, MasterCard is a company with an exponential growth, which in my opinion is currently undervalued. I decided to invest in MasterCard at the moment instead of Visa because of its growth potential in comparison to the industry. As you can see, Visa is a very good stock, but their EPS growth in comparison to the industry is not as huge as we saw with MasterCard. So for the long term, I do expect MasterCard to perform way better than Visa as it has been happening in the last 5 years. Second stock I want to talk about is Alibaba, ticker symbol BABA. It is a company based in China, but they do business all over the world. People like to call it the Amazon of China since they are the leading provider of e-commerce there. They own different businesses such as AliExpress, which is a global retail marketplace, Alimama, which is a monetization platform, Alibaba Cloud, which is their cloud computer, and the list goes on. And let me tell you something, their cloud computer is something that no one is talking about, and it has been having an amazing growth lately. It reached $1.5 billion for the quarter with a 62% growth. Now, their total revenue is not that far behind since they had a growth of 40% year over year. Alibaba has a market cap of around $522 billion and a PE of 20.59, which is amazing in comparison with the industry as well as their EPS growth. Basically, we are getting a cheap valuation with a massive growth potential. Even though they are a growth company, their balance sheet is amazing. As of December 2019, their cash on hand increased 79% since December 2018. They had a current ratio of 1.75 and a total debt to asset ratio of 0.34. They could basically pay all their long-term debt with their current assets, convert into a debt-free company, and still have more than $49 billion in current assets. Alibaba is a sleeping giant in my opinion, and that might be because it's a Chinese company and normally a lot of people does not feel comfortable investing in this type of companies. But the potential that Alibaba is currently offering is incredible. I mean, they have shown a growth of about 40 to 70% in their revenue year over year, and still analysts are expecting them to continue increasing 30% in their revenue for 2020 and another 30% for 2021. Next stock in this list to buy on May is Advanced Micro Devices, ticker symbol AMD. They are a semiconductor company. AMD create computer chips or CPU for computer, which is basically the brain of every computer. Obviously, you've heard of Intel chips, which are the market leaders on CPU chips. You might even have one of the Intel chips in your computer right now. But AMD is a competitor of them that has seen a massive growth in the last few years. AMD has a market cap of $61 billion and a trailing PE of 121.30, which obviously is way higher than the industry, as you can see, but just look at that EPS growth, 72%, when the industry is just 6.37%. For the Q1 2020, they reported $1.77 billion in the revenue, which is a growth of 40% in comparison with the same quarter of 2019. But that's not the best part. The best part is that they reported a total net income of $162 million, which is a huge increase of more than 900% in comparison to last year's Q1. They currently have a total of $1.3 billion in cash and cash equivalents and a total asset of $5.86 billion. Yes, their total assets decreased almost 3%, but their total liabilities also decreased more than 11%. Still, they have a current ratio of 2.21 and a total debt to asset ratio of 0.48, which is incredible for a company that has seen such huge growth over the last years. I'm saying this because you would expect a company with this type of growth to have a way higher total debt to asset ratio, as we have seen with other companies. Take into consideration that normally a growth company like AMD tends to experience more volatility than stable companies in the market. For this stock, I want to see it at a price of around $46 to feel a little bit more comfortable buying it, and if it gets below that, even better. I do expect this company to have an exponential growth over years since they still have a lot of room to expand. Next stock is Berkshire Hathaway, ticker symbol BRKB. A lot of you guys, if not all of you, might already know who Warren Buffett is. Well, he basically is the founder and owner of Berkshire Hathaway, which is a company that has a big ownership in a ton of different companies. Very huge companies such as Geico, Fruit of Looms, Duracell, Dairy Queen, and so much other companies. So basically, when you are investing in a stock like Berkshire Hathaway, you are buying a little slice of all those businesses. And not only that, they also have a lot of investments in other companies, like for example, Apple, which is their biggest position with 250.8 million shares, which at the time I'm filming this video, Apple is at a price of $300. So basically, they have more than $75 billion in these stocks. Wells Fargo more than $8 billion, Coca-Cola, MasterCard, Verizon, and the list goes on. Obviously, what I like the most about this company is their valuation. Berkshire has a market cap of $419.4 billion, a very, very big company. They reported earnings last week and had an increase in their revenue of only 2% and a net loss of $49.7 billion. Now, we have to take into consideration that there is a new GAAP rule which requires any company holding equity earnings to include in their earnings the net change in their realized gains and losses of those securities. What that means is that if a company owns stocks like Berkshire does and the stock goes up or down, they have to record that change as a profit or a loss, even though those are unrealized gains since they haven't sold those positions. Because of that, we have to take only into consideration their operating earnings, which actually increased 5.6% year over year. Their balance sheet is even more interesting. Look at their cash and cash equivalent and their short-term investments. We're talking about $133 billion in money that they can use whenever they want in any investment out there. That is an increase of 6% from Q1 of 2019. They have a total asset of $760 billion, and even though it decreased 7% since 2019, they still have a total debt to asset ratio of 0.5, leaving us with an equity of around $375 billion. And keep in mind, we are paying a market cap of $419 billion for this company, so this is very interesting. I am personally planning to buy this stock to hold for a long term since I see it as a very stable company and can be kind of a hedge for my portfolio. I do see this company growing in the coming years, and if you have faith in the banking industry, then this is definitely a stock to buy and hold. Last but not least, my fifth stock is Lyft, ticker symbol Lyft. Obviously, you all know what Lyft does. They are a ride-sharing company. I do have a video talking about Lyft and Uber since just like MasterCard and Visa, I currently own both stocks, but right now I will increase my position in Lyft and let me explain you why. Lyft reported earnings yesterday and had a revenue of $955 billion, which is an increase of 23% since Q1 of 2019 and a net loss of $398 million. And yes, they were not profitable at all, but that was a huge improvement since last year they had a net loss of $1.14 billion, which is a 65% improvement. This tells me that they might actually achieve profitability as expected next year. Obviously, everything depends on the virus situation. Currently, they have a total of $2.7 billion in cash and cash equivalents and short-term investments. If we divide their total current asset of $3.14 billion by the total current liabilities of $2.55 billion, we get a current ratio of 1.2. Lyft has a total debt to asset ratio of 0.53. In my opinion, that is incredible because they might not be profitable at the moment, but they still have enough cash to pay all their liabilities when they are due without having to enter into huge debts even with this current market conditions. Even though Uber is a more diversified company with Uber Eats and some other stakes in other ride-sharing companies around the world, right now I prefer Lyft over Uber because of the growth potential Lyft is offering. They only operate in the United States and Canada, in comparison to Uber that already operates in 85 different countries. And now guys, after this video, I do recommend you guys go and watch this video right here or this playlist right here. That was all for this video guys, I hope you enjoyed. Don't forget to subscribe, smash the like button for the YouTube algorithm, and follow me on my Instagram. Stay safe, stay home, thank you, and see you next time.